On everybody, welcome back to another video. In this video today, I'm going to break down how I'm investing my money right now during obviously this coronavirus outbreak coming up right after this. Back to the channel that's all about real estate. If this is your first time tuning into my YouTube channel, welcome. My name is Alex. I post videos 3 times a week, every Monday, Wednesday, Friday. So if you haven't already, hit that subscribe button down there. And if you get any value out of any of these videos, hit that like button down there as well. And now on to the video you're waiting for. I thought it'd be appropriate to make a video since everyone's gonna be staying at home. And obviously yesterday we got issued to stay in our house, enforceable by law. So with that being the case, I wanted to make a video with, what I'm doing with my money right now, to make some extra money, obviously during these times that, nobody's probably working. It's super simple. I'm just buying stocks that I believe are undervalued, and I'm just buying them as they keep going down to lower my average. And I'll show you kind of what my portfolio looks like right now. My plan going forward, obviously I was in a cash position because I sold my stocks before this all went down. So I liquidated everything, took some of the profit I had, and now I've just been kind of buying this dip, which obviously a lot of people are. Right now, this morning, I think I'm up around $6,000, almost $7,000 in my portfolio in a week's time, I would say. I'm holding about 12 stocks. If you're new to stock trading, you're gonna have these periods where the market's going up a lot, okay? This is called a bull market. Right now, we're in a bear market. It's going down almost every single day you wake up and you see the stock market down. It's actually up today. It's just very volatile right now. But if we look in the past, and obviously you can see that the bull markets are a lot longer than the bear markets, right? So a lot of people are saying this is a great opportunity to buy because a lot of these stocks are way undervalued compared to the revenues and earnings per share that they're bringing in. What's unique about this time going into a bear market is that we know the reason to why this is happening, right? The coronavirus is affecting the whole economy, the whole supply chain. Obviously, businesses are having to shut down, hurting earnings report, hurting revenues. People are getting scared. They're almost trading off emotion, selling all their stock, right? Which is making all these prices plummet way down. So we know the reason behind what is happening. On the other hand, if we look back in history, like the 2008, 2009 recession, this was because of obviously, people selling horrible mortgages, mortgage-backed securities, bundling them together as CDOs. And then obviously these people, when the adjustable rate mortgages that they had, they increased the rate, they couldn't afford them. All these people started foreclosing on their loans, and then the rest is history, right? So we can assume that's why that happened, but we don't know exactly the reason behind some of these other recessions in the past, right? We speculate, but we don't know the exact definitive reason. This time around, we know the exact reason, and it's the coronavirus. This all being said, I believe right now is a great opportunity, and I really believe if we look back in history, we look at all the bull and bear markets, obviously the bull markets always come back after a bear market, and I think that, a couple years down the road, people are gonna say, do you remember 2020 when the PE ratio of this company was this, when the company's share price was this, now it is this? I think this is a great buying opportunity, but you need to know what companies to look at and what sectors that are undervalued. Well, the PE ratio is one of the most common metrics that people use. It's simply just the share price divided by the earnings per share. Okay, and this is a great metric, that you can use to value the companies and find out whether they're overvalued or undervalued. To look at PE ratio is super simple. So say, for example, company ABC had a PE ratio of 15. In simple terms, that would mean investors are paying 15 times earnings, or even more simple terms, you're willing to pay $15 for every $1 of profit. It's really important when you're looking at PE ratio to obviously look at other companies within that same sector, right? So you can compare different companies' PE ratios to see if maybe that company you're looking at is overvalued or maybe it's undervalued. Maybe you're looking at this company that has a PE ratio of 45 and maybe all the other companies in that sector are very similar. So you think it's overvalued, but really it's like a normal PE ratio. Next metric I look at is beta, and this measures volatility in stocks. I'm the type of investor that I obviously don't like wide swings in stocks every single day. That would be more like a low capitalization stock that you might have a higher return, but it's a way greater risk to you. I would recommend you just look at higher cap stocks. This is going to include your brand names, Apple, Microsoft, Amazon, Google, Netflix, companies like that. So the beta of the stock measures the stock's volatility in relation to the overall market. So if the beta is around 1, okay, that means if the overall market goes up 1%, that stock's gonna go up 1%. If you had a negative beta, that would mean that if the market went up, your stock would go down. I'll pull this up on the screen and give you an example. So take a look right here, ticker symbol HSC. This is a low cap company, has a market capitalization of $590 million. And then you can see right under here, it says beta, 5-year monthly, okay? And it's beta 2.27%. This is an extremely volatile stock. So basically what this is saying is that if the market goes up 1%, this stock could go up almost twice the amount, or 2.5, whatever. And if the market goes obviously down, well then this stock could go down almost 2.5%. And when it's trading at only $7 and some change, right? If you put a big position in this stock, you can obviously lose a good amount of money unless you know something that someone else doesn't know. And obviously maybe there's some news coming out that this company's making this product that's gonna affect a lot of people, etc., etc. So the next ticker I wanna look at, everyone knows this, the common Apple Inc., AAPL ticker. Obviously huge market capitalization. It's actually back into the trillions now, trading at 241 at just over $1 trillion market cap, excuse me. So this is considered a high cap stock. Okay, so the volatility in this stock is gonna be a lot less than the other stock, with the beta sitting at 1.29, right? So this isn't gonna make huge moves, but it still can make huge moves. But if you're looking for obviously a higher risk, higher return type of stock, you're probably more of a type of investor looking at a low cap. But the low caps are very, very risky. Obviously there's other ways to value companies. Obviously you need to look at their financials. Every single stock that is on the stock market has to disclose their quarterly financials and earnings reports, right? So you can simply just type in whatever it is, Apple. You can look at how much money they made per quarter, how much they made in 2019. Are their revenues going up? Okay, and is their net income going up as well? That's the main indicator. That's what you want with a business, right? You want obviously their revenues to go up, right? So their trend is going up. That's gonna make more investors happy about the company, and more investors wanna put their money in the company, which makes the stock price go up. All right guys, there you guys have it. Hopefully you guys liked the video and got some value. If you did, hit that like button down there, and we'll see you guys on the next video. Peace.